let's get rolling here, guys, this morning. So yesterday, beautiful trading day yesterday. We actually hit our target. So yesterday morning, if you did not play, we did two videos yesterday, one at 8:30 and one at 9:45. So if you want to play the one at 8:30, what we did, we projected this high at this level. This is projected at 8:30, and at 9:45, we hit the high of the liquidity grab zone, and we had a target, and the target was projected at 8:30. This was our target. That was our target. Our target actually hit at the close all the way down. So at 8:30, replay the video. 9:45, replay the video. When price action was right here, I went over the exact sell zone that we're looking to sell or short for the session. It came up right into the POC, or the point of control, went right inside of our liquidity grab zone. So I don't need to tell you the reasoning behind that. Just replay yesterday's video at 8:30 and 9:45, and you'll see two back-to-back setups, one there and one here. I'll show you in a second. They were both sell setups, and play those videos to see why that the retracement was a short. At the time, the market was at 2019. It got as high as 2030 and a half. It went right inside of my liquidity grab zone. My target for the entire trading session, I marked it up at 8:30. At the close, my target was 69.86 and a half. The projected short was the 30 level, and it ended up hitting at the close after the Fed came out with the Fed funds news. So how do we get those? And what's our targets for today? We're going to go over that. So let's first go over the targets for today and what we're looking for, and how can you project this target at 8:30 in the morning at this level, and why did price action go down to that level? All right. So the first thing you want to do, this is your roadmap. All right. This is your roadmap for the entire trading session. It lets you know where all the trading participants are in the market. So this big red thick line, that's a high value area. The big blue thick line, this is volume profile, by the way. It's been around since 1994. This is the POC, or the point of control, the most volume that's traded on the S&P. And this is the low value area. Okay. So these will shift and become locked in and become static. They'll lock themselves in and not move. And this LVA actually was up here at this level at that sell zone right there where my arrow's at. And the point of control was exactly right at, and it was static at 9:45 yesterday at my projected sell. So this is a retest of the point of control, retest of the low value area. This is actually retested the developing profile. You can see right there, the little green line. This is where volume profile was yesterday for you members, or for those of you that lease a software outside the room. That was our short. So these were the two big short opportunities yesterday. And they were projected an hour and 15 minutes before it happened. Replay the first video, like I said. Replay the second video. You can see these are projected about an hour and 15 minutes before it happened. This exact sell zone. And my target was all the way down here at the 86. What you want to do, the reason the market gravitated towards not only this sell zone, I'll show you in a second how my liquidity grab zones called that high before it happened. But the reason the market gravitated towards this level, you can see how important this level was. Look at this, these lows since yesterday. Previous market profile acts like magnets. So they act like magnets. So they are areas of support and resistance where the market likes to gravitate towards, because that's where all the trading participants have been. In other words, all the hedge funds, prop firms, banks, amateur professional traders, they're leaving their footprint in the market. This is their footprint. High value area, control point, low value area. They're leaving their footprint where there's accumulation distribution in the market. This creates a level where the markets like to go to. So if I skinny this down yesterday, before prices trading, this is 8:30 when I did my first video before I projected that high, possible high right there. Projected this low in the market for the day, or actually target, not the low, but the target, because it could have kept going down to my next target. Why did it go down to that target? I simply looked at the previous market profile. Previous market profile was sitting right at there at that level. The beautiful thing, when you see big gaps in previous market profile, they tend to fill. What does that mean? Look at the low value area, the control point, and the high value area. Look at the big gap in between the profiles. When you see big gaps like that, these gaps tend to fill, and they tend to fill rapidly. So if we ever do break, so I projected that forward on the video yesterday. I did at 8:30, projected this point of control and LVA. So that was our natural target. Not only did we're looking for a short, which it caught the high, the projection, it went right down to it, and that was the low of the session. Now, these levels are still intact, so I don't have to remark these levels, because if the market ever breaks through the high value area, look at the gap in the market we have. You should see the market run down to this level at the point of control. That's 32 3/4. The reasoning is, look at the hard candle that went up, the 5-minute candle. Look at the big giant 5-minute candle. Huge 5-minute candle the day before the Fed came out. That means there's no underlying support, no underlying resistance in between these gaps. So that tells me I got two big tradable gaps all week this week, all week next week. And these are my two tradable gaps I want to leave on there. Now today, if the market wants to rebound, which is doing already in the overnight session, you can see my target is caught the low, moving up. I want to find out where the resistance is on the breakout. So I simply look at my previous day's market profile again, and it's going to give me my targets. So I come in and I look at the profile. There's a POC, mark that down in blue, very simple. There's my high value area. This is my ultimate breakout level where the market, if it ever breaks out this level, you should see some short covering, and the market should take out all those stops, and you could see a parabolic move to the upside right there. So now we know the breakout level in the market. All day today, we know the levels that the breakout levels are. We know the breakout levels at 70 or 70, 30 and a quarter. We know the breakout level is 70, 39 a quarter. So I got 70, 30 to 9 a quarter for a 10-point possible move, just under 10 points. And after that, there's no resistance. That means all these buy stops should hit, and we should see a parabolic move. That's how you project future price targets, just like I did yesterday. Projected that price target at 8:30 in the morning, went right down to it, caught the low, moved back up. This is not my opinion. I'm not trying to forecast stuff myself. I'm strictly looking at order flow. I'm strictly looking at previous market profile levels. This chart is the roadmap for targets and major support and resistance levels for the day. So we're going to put that off to the side. We got our targets now. Now we got our target. So we skinny that down, move it over. We're in between the value levels. So we're in a balanced market right now. So now we got our targets. Just like I skinnied this down yesterday, went right down to our target. So we can clearly see if we clear the point of control yesterday at 70, 30 and a half, we should move up to 39 a quarter. So we'll watch our chart here to find out if that's going to have success. Now, let's take it a step further. How did I project this sell zone at 8:30 in the morning? Price action was right here when we did the first video, played the first video. You'll see price action was right at this level. All right. So how did we project the high of that move? I just showed you how we projected the target. The target right there, 86.5. I showed you how we projected that. It went right down to it. But how do we project this high and how do we project this second short? So I have a little chart up here. There's no, like I said on yesterday's videos, there's no magical moving averages out there. All right. But this chart gives me a clue what they're trying to do. So these are just simply very simple moving averages. I'll show everybody what they are. I mean, it's a 50, it's a 20, a 50, 100, and 200. EMA, you can use SMA, whole moving average. It doesn't matter what EMA you use. It just gives you a sort of a roadmap what the market's trying to do. Okay. It just gives you a quick feel for what's going on. And what I saw yesterday when I gave that projection of the sell, here's our liquidity grab sell that happened right there to start that big move down for the day. Right there, that high. The 20 EMA got closed below. This started the overall push to the downside. So on that retracement, you could get a quick feel just by looking at 20. When it closed below it, we typically move down to the 50. We close below the 50. We typically move down to the 100. Close below the 100. We get down to the 200, etc. Okay. So that weakened the market. Just by looking at that, it gives you a feel to be on the right side of the market. For example, if you're in a hard downtrend, you're going to look like this. These were all sell liquidity grabs that happened at these levels with my software. Sold the high, sold the high, sold the high. Well, look at the moving averages. It takes you a half of a nano of a second to realize you're below the 200, below the 100, below the 50. The market's in a downtrend. So if you take any shorts, I mean, any longs between January 17th to January 22nd, you're on the wrong side of the market. You should be shorting liquidity grabs, short liquidity, short liquidity, short liquidity. When you got back above the market, I went over this in yesterday's video. I don't have to show you the trades, but I showed you in yesterday's two videos. These are big buy liquidity grabs. Buy, buy, buy. Why? Look at your MAs. You're above everything. Yesterday, here, these are buy liquidity grabs on buy. And then all of a sudden, it closed below the 20 for the first time. And then my projected short liquidity grab called it. And sure enough, the algorithm was correct, called that high, and then it ended up going down to the target. So this is a great way to just get a quick feel. You know, look how the 100 held. It broke the 50, and then it broke the 50. So what you're thinking is, you're thinking, okay, let's sell more liquidity grabs, which my liquidity grab caught this also, went back up, and just crashed down to the 100. Now we close back with a 50, 200. We're moving higher today. We're trying to move higher today. All right, so that's just, I have this in the upper left-hand corner for you. You can put on your own charts. It's just a good read with market profile of what's going on internally with the market. You know, moving averages are worthless to me, absolutely worthless. You can't do moving average crossovers or MAC crossovers or all that baloney. They're all lagging indicators. They're terrible to trade with, but they're great for trend direction. All right, so now we have our roadmap. So I got two things checked down now. I got my target levels over here on my market profile. I know when the breakouts are going to happen based upon previous market participation. Not my opinion. That's strictly order flow. I can see my big breakout today is 39.25. If it breaks out, control point 30.5. We should move to 39.25. Above 39.25, market could go parabolic, short covering. We could see some wild moves to the upside. If we break down below my PP today, which is 70.13.25 to the far right, what's my target? Double bottom, all the way down to 87. Here's my target. All right, so that's a roadmap. Now we got a roadmap. Now we know what to look for. Now, how do we look at these trades? Now, I showed you this bottom left chart yesterday on my two videos, and this is just a quick feel for in the market. So they're both green levels. They're both zoned. The green zones are green. So what does that tell you immediately as a trader? They're buying liquidity. They're buying liquidity pullbacks. If it was red, they're selling liquidity pullbacks. So if it's red, they're selling liquidity pullbacks. Look where they trapped all the traders. And this is just a really good feel for how the market works. As long as I don't close, and the keyword is close, outside of these outside zones. See how it came inside of it, then crashed back down? The market pulled all the way back up to 70.14 yesterday into the Fed, pulled up to 70.14 3/4, and then crashed down to my target, right? It was sell. It was sell. They're selling liquidity all day after 11:36 all the way into the close and hit my target. They were shorting. We had major shorting opportunities on the liquidity grab shorts yesterday afternoon after the Fed came out. It hit liquidity grab zone, sell. Liquidity grab zone, sell, sell. Vice versa, look at the previous 2 days. What were they doing? What was the institutional and the hedge funds and the banks and so on? What were they doing? What were the professional traders doing? They're buying liquidity. Look at these dips. It takes you a half a nanosecond. Look, they're buying. So you don't want to short into this move up. You don't want to short this move. You want to be buying liquidity grabs. And I showed you in yesterday's video all those, how my zones caught the low on the smaller Ricoh charts. You want to buy. So if you get caught shorting this move up, you're going against the market, and that's how you get run over. You're trying to jump in front of a runaway train. And if you bought yesterday's market when we had sells, when we only had sells on yesterday's trades in the zones, then you're trying to catch the falling knife. You know, Fibonacci's are not going to stop price action. Elliott waves are not going to stop price action. Simple moving average crossovers or MAC crossing back over in an uptrend or downtrend is not going to stop price action. The only thing that's going to stop price action is the market's trying to find the next fair value level. The fair value level was the target I showed you. The targets I showed you today for today. That's where the market's trying to gravitate towards. A lot of traders don't understand that. The market's very, very orderly. It tries to find the next value level. That's what it's trying to do. It's very orderly. What we have to determine really quick, and that's why I like this chart as just a visual tool, and I like to see if these lower liquidity grab zones hold, right? You have to determine real quick, are they buying liquidity? Are they selling liquidity? This chart helps you out. So you can see right now they're buying liquidity. Right now we're buying liquidity. As long as I don't close below, and the keyword is close below this level, they're buying liquidity. They bought this big dip liquidity here. They brought it all the way down to 85 3/4 and brought it all the way back up to 22 3/4. They trapped all these traders that were short the market. So they bought liquidity. So that's what this chart's for on the bottom left. It shows you just a quick reference what the market's doing. They're buying liquidity right now, right? So now I got a check down of what the market's doing up here with moving average direction. I got the internal market of what's going on with my zones. What's internally going on? Are they buying liquidity, selling liquidity? And then I got my roadmap over here. Once we break out of this high value, low value area, we're in a balanced market. We break outside of this zone. Right now we're balanced. Once we break outside of this zone, we become imbalanced. And then once we become imbalanced, what does the market like to do? We should come all the way down to there if it breaks a low today. So if we break below 70.13 1/4, we should come revisit it's actually 1, 2, 3, be the fourth time it's tested this level, which to me, if it ever tests this level, anytime you test the level 3 times, it typically breaks. We'll probably go down to this control point. And there's open air below us. There's nothing holding us back on the chart. Between 69.86.5 to 69.32, there's nothing on the chart. I don't care if these Fibonacci traders or these MAC traders or these pivot level traders saying, oh, there's a pivot level there. It doesn't matter. It's a pivot level. It doesn't matter. It's a Fibonacci level. Those are confirmation tools. They're not entry tools. Those are second tier indicators. first tier indicators market profile. It trumps all these indicators. Thousands and thousands of indicators out there. Market profile trumps it all because it's the actual order flow. So it tells us there's nothing below us. I don't care what indicator is out there. There's nothing, no support below here, no support there. That's why the target hit yesterday. Of all those thousands of indicators all the way down saying buy, we're wrong. The market just gravitated down, went down to the target. It's trying to find fair value. So same thing here. If we get below 13.5, it's trying to find fair value. If we get below 86 3/4, trying to find fair value down to the control point. So we know our roadmap. So last thing, we got a roadmap over here. The last thing we need to piece together is entry. Entry is this chart. So let's go over it. Yesterday, this is where we were on the first video. Let me show you the liquidity grab zone. The liquidity grab zone was here. Let me move this out of the way. Why was that a liquidity grab zone, and why was I projecting this as the sweet spot to short the market after we close below our 20 MA over there and our market profile suggesting we go all the way down to 86.5? It's these two dashes. That's your zone. That's your liquidity grab zone. So the market was already moving down. It was moving down. We're moving down. When we did the first video yesterday, I said this would be the sell zone. This would be the liquidity grab zone right in between there, in between this high and this low. As long as we don't close above this high, you cannot close one candle. Just one candle outside that zone nullifies the trade. It cannot close not even one candle outside that zone. As long as I come inside that zone, which it did, we're looking for a reversal. Now, what's neat about this trade, that's where point of control was. The most volume is traded. The rule of thumb, like I said yesterday in the videos, if you're below the control point, it's a bearish push. If you're above it, it's a bullish push because that's the most volume is traded. If you break the control point and you start getting away with it on the downside, then you must think to retest the control point for a short. You must think to retest the control point for a short. If I'm above the control point and I retest the control point, you must think to buy the control point on a retest. It's that simple. Retest the control point, actually stop right at it, right inside my liquidity grab zone. Here's our first 10-point push, first trade of the session. So then my second video, I came on at 9:50 yesterday, 9:45, and I said, listen, the next liquidity grab zone, the next pullback is still a short because we're still in a downtrend. Our target's still, the magnet's still at 86.5. Play that second video. You'll see my reasoning. And I said, if it breaks this PP target, our price profile was sitting here at this level, and this is the 50-day moving average on this chart over here, the blue line. I said, this is our next ledge. I told the traders in the video, this is our next ledge, our next sell point. And our target would be all the way down to 86.5. Sure enough, it broke, went down to 86.5. But once again, the market came up, it broke low value area, retested LVA, and the market proceeded down to my target for the day. So not only did it retest the point of control, it retested the low value area, and the market moved down. Now, what are these blue lines? These blue lines are my 5-minute opening range I went over yesterday. The first 5-minute opening range of the futures market, and you can do this on the NASDAQ futures or whatever. If you do anything in stocks, you do whatever. I put this 5-minute range. It shows you the pressure of the market. The pressure of the market was down because it closed below the 5-minute opening range here at 10 o'clock and started moving down. Any retest of that opening range on that push back up, as long as I don't close above the high of that opening range of 29.25, you got to sell. So this is a retest of the opening range, and it was right at the low value area, market profile, and I gave us confluence. That was our second trade of the push. This one also retested the high. This retested the high of the opening range right into my liquidity grab zone. This had 3 times confluence. Retested the high of the opening range. hit the liquidity grab zone in my POC. Time to trade. There we go. Okay. So that's what we're going to do. So we're going to look for today we're going to take this 5-minute opening range off until 9:30. All right. So we're going to look for today. We're going to look for the market to find a direction first on the roadmap. Right now that MAs look up, they're buying liquidity grabs on our larger chart over here. So everything's pointing to the upside. So if we can break out at 27.75, that's going to tell us to start buying liquidity, right? If we break below 14 or 70.13 3/4, we're going to short liquidity. Well, just look at your zones. If we break out of 27.75, you're going to start seeing these green buy zones like this. These green buy zones, just like that, start firing off. They're going to start setting higher highs or higher lows, sorry. So what they're going to do, they're just going to move up like this. Higher low, higher low, higher low. And what we're going to do, if it breaks out of this level today of 27.75, once the market starts setting higher lows, we're going to look for a pullback into that zone, and we're going to look to take it higher. Now, if the market breaks below 70.13 and it starts printing liquidity grab shorts, our zones start printing red, then what we're going to do is we're going to look for the market sitting lower highs. We're going to look for the market to pull back up into the zone, and then we're going to look to take it short, just like that. Okay, so it's all determined when the roadmap breaks out in one direction. I know the Fed was yesterday, so the market's sort of oscillating around. You can see my market profiles calling the high, calling the low this morning, it's oscillating around right now. You can see market profile just called the low here at 755, getting up to the high. It's rolling back over, so it's oscillating. When you're in between LV, this is a price profile here, volume. We're oscillating in between price and volume profile right now. But once it clears that, then we're at open space. This is what a lot of traders don't get. All these other indicators, they stack all these indicators together. And they said, well, if this indicator and this moving average comes together, well, it doesn't matter because the market is trying to find fair value. It doesn't care about those indicators. Those indicators don't show true order flow. What the market looks for is trying to find fair value. It's going to try to oscillate down or move down to 86.5, or it's going to try to move down to 33.5, or right here it's going to move up to 30.5, and then 38.5 after 38.75. Then it can go parabolic because there's no resistance. It's only buy stops. Down here, once you break this level, you're going to see the sell stops come in. It's all about order flow. So that's why market profile is such a great tool. We got traders that actually come in that don't even log into the room, that do yearly subscriptions on our market profile, just for market profile. We have a lot of traders that love our market profile just for that reasoning, and they use their own tools just with our market profile because it's so neat on picking out where order flow is. It shows you exactly what we need to do, where roadmap is. All right, so this is our roadmap for the day. We're going to see which way it breaks. Once it breaks, we're going to look for our sell or buy zones to pop up. You can see it's oscillating in between profile. Right here's the sell zone. And here's your buy zone. So it's oscillating in between. We want to break one of these highs or lows. There's our liquidity grab buy zone. So we want the market to break out here to look for a valid setup to catch the wrongly positioned traders. Or we want to break the low of here. Once it breaks out, you can see market profile will break out. It's trying to break out low value area here. If we break to the downside, our natural targets are going to be a double bottom. But I'm telling you right now, and I'm going to put this out there, is it's tested several times on this low value area. Look at it. 1, 2, 3 on my market profile levels. That educates me that not only should we go down and test a double bottom if we break below low value area, it tells me we're trying to hit to the control point. We may see 69.33 today. You're like, man, that's far away. 69.33, you lost your mind, right? It's 70.16. Well, it can happen because there's a hole in the market right here. Look at the market. It went straight up on this 5-minute candle. There's no underlying support. Just like here on this, when it's trying to get down to 87, if we break through this PP, there's no underlying support. None. So when you see these big targets way away and these big holes in the market, don't think the market can't go down there. Because what happens is you get all these traders that try to fade the market and try to buy the low on the way down, buy the low, and they get wiped out. I can't tell you how many traders that come in and outside this room and they email me and tell me about how their trading account got wiped out or this and that. And the first thing I ask them always is, do you counter trend trade the market? And almost every single time the answer is yes. They're countering the market. They're using all these indicators and they're countering the market. They don't think it can go higher and they don't think it can go lower. Well, the market can go higher and it can go lower, even if it's up 100 points. It can still go higher. Buy high, sell higher, short low, cover lower. That's how the professional money always trumps the amateur money, because they're selling low and covering lower. They're selling low here and covering lower. A lot of traders, they see this, it hits a pivot level, it's got to be low, get wiped out. Pivot level, wiped out. Pivot level, wiped out. Pivot level, Fibonacci, wiped out. Moving average crossover, wiped out. And they wonder why. Because the market's trying to find fair value. The fair value levels are previous market profile. These are levels. This is your roadmap. That's the levels for the day. And if you get outside of a level where there's no market profile above you, the market can go parabolic. We break 70.40, we may see 7,200. We may see 7,100. We may see 7,500 on the S&P. They're like, wow, that's a new high. Lost your mind. Well, that's how traders get wiped out. They try to overthink things. You break 70.40, this market could go parabolic on us. And we'll watch it. Breaks out, we're going to be buying liquidity grab zones. Buy, buy, buy. We break down, sell liquidity grab zones. You break down today, 87, sell the zone, sell the zone, sell the zone. Get down to the target. Okay? That's how we're going to do it today. That's our roadmap for today, guys.